Hello and welcome. My name is Kanak and welcome back to my channel. In today's video, I'll explain you why you should be a lazy stock market investor, which simply means you should be a passive long-term index investor. Now, being a lazy stock market investor might sound like a contrarian opinion compared to what most people on YouTube would suggest. Most YouTube videos will tell you to constantly buy some stocks and sell some stocks. But the topic I will discuss today is contrary to most investment advice on YouTube. In fact, by being a lazy stock market investor, or in other words, by being a passive long-term index investor, statistically you are more likely to generate higher returns than most people, as well as professional money managers who are trying to beat the market by buying and selling stocks. While this may sound like the most boring investment strategy, statistically over a very long period of time, you will end up generating more money than most people who are trying to generate more returns than the market. Numerous academic studies over multiple decades have proven that over long periods, index funds outperform most professional money managers. As you can see on the screen, over 1 year, about half of actively managed mutual funds underperform index funds. As the performance period increases from 1 year to 5 years, the percentage of underperforming funds rises to about 75%. When the period extends to 10 years, almost 90% of actively managed mutual funds underperform the index. This trend is true across large cap, small cap, and international stock funds. Over 20 years, almost 95% of actively managed mutual funds underperform their corresponding index funds. Now, you might be surprised, but the trend of index funds outperforming active mutual funds is also true in the Indian stock market. What you see on your screen is the data from Spiva research conducted by S&P Global. The percentage shows what proportion of mutual funds in India underperformed their corresponding index. As you can see, across all fund types, large cap, mid cap, and small cap stock funds, most active mutual funds underperformed their corresponding index funds over long term, that is 5 years or more. So, if you are investing for the long term, such as to buy a house 10 years down the line, or for retirement in 20 to 30 years, simply investing your money in an index fund and staying invested will enable you to outperform most professional money managers. Not only that, but you will also save significant money on fees. Actively managed mutual funds are more expensive and underperform the market over the long term, such as a decade or two. So by investing in index funds, you will save huge money on fees and also generate more returns than most mutual funds over the long term. And now if you think a small percentage difference won't make an impact, remember that over a long period of time, money compounds. Even a 2% lower returns can amount to hundreds of thousands or even millions of dollars over 20 years. So a small percentage difference can compound to a very large amount over a long period, such as a decade or two. Additionally, by simply investing in index funds, you will save a lot of time and mental worry about buying and selling stocks. You can then focus on your core job or business to generate more capital to invest in index funds, which can further compound over a long period of time. Whether you are a doctor, engineer, plumber, or in any other profession, passive index investing will help you dedicate most of your time and energy to increase income from your primary profession. You can then invest the excess income into index funds and let it compound over a long period of time. Now, this video is not to say that you should not buy individual stocks. If you have the expertise to analyze a company's financial statement, enjoy analyzing different companies, and have a passion for finding investment opportunities, picking individual stocks might be the right choice for you. However, you must be aware that by being a stock picker, there is a significant probability that you might generate lower returns than the market over a long period of time. Secondly, even if you decide to be an individual stock investor, you must still plan how much of your portfolio to invest in index funds and how much to invest in individual stocks. As Charlie Munger once said, you do not get rich in the stock market by buying and selling, but by waiting. And studies have also shown that frequency of trading in stocks is inversely correlated with returns, which means the more you trade, the more likely you are to generate lower returns over the long term. Remember, all of these results are over the long term. You might get lucky and beat the stock market over a period of a month, 3 months, or even a year. But consistently generating higher returns than the market over 10 or 20 years is a very difficult task. Now the next question is what index funds to invest in. For US based investors, you can choose to buy the total US stock market index funds such as VTI, which represents the total US stock market. For investors based in India, you can pick the Nifty 50 index funds, which represents the 50 largest companies listed on the Indian Stock Exchange. Additionally, you can invest in mid-cap or small-cap index funds offered by various asset management companies in India. So in summary, by being a lazy index investor who invests in low-cost, low-risk, high returns and well-diversified index funds, you will outperform most professional money managers and active stock pickers over a long period. Thanks for watching till the end, and if you find this video helpful, then hit that like button and subscribe to the channel.